Has the Fed lost its way? Welcome to Real Vision Daily Briefing. It's Friday, April 26th, 2024. I'm Ash Bennington, joined by my old friend, Jim Bianco, president of Bianco Research. Jim, it's been far too long since we've gotten to do one of these.
Yeah, I'm excited about it. Thanks for having me on this Friday afternoon.
Man, it's great to have you back. Listen, Jim, I've been hanging out in crypto land, keeping an eye on what's happening in traditional finance and capital markets in macro. Catch me up, bring me up to speed, big picture. Where are we at this moment right now?
Uh, the thinking has been changing that we are going from any kind of idea about a soft landing and rate cuts, that those are gone. Rate cuts are gone. Maybe one, in December if the data were to slow down. And we're at higher for longer land. And the H word, the hike word, is starting to sneak into the conversation. Nothing to the point where you'd say that there is a hike. What was curious about today's action was the arguments, the narrative you were hearing was the inflation data was a little bit hotter than expected. That's PCE and core PCE and consumer spending and consumer and personal income and personal spending. A little hotter than expected. Yep.
On an annualized
but
basis.
It wasn't hot enough to bring up a hike. So therefore it was bullish. And that's why I was like, wait a minute, now we're going to the H word here. And so that might be the narrative as we go forward from here. Is the data actually crossing that Rubicon that we actually might be talking about hikes? We're not there yet, but it's starting to creep into the conversation.
Yeah, by the way, we should also mention disappointing GDP print coming out earlier this week. So you do see this potential risk, at least the chatter about stagflation.
Yes. And the reason you're getting the chatter about stagflation is while the number was disappointing, it was largely driven by exports and inventories, which are very volatile cyclical components. And the inflation part of the GDP report, which is the PCE deflator, was stronger than expected. So higher inflation, weaker data, or weaker real growth. And that was where the S word, we got all these single letter words coming here, stagflation started to kind of creep into the discussion.
Hey, talking of which, we've been mentioning this chatter. I want to point to some of our old friends here on the network, Tom Thornton, Kevin Muir, and Urian Timmer. Let's just take a look at this clip to give a little bit of context and a little bit of setup for what some other folks are thinking and saying about the Fed.
And the Fed's going to be in a bind. They want to cut. We know that. We know they want to cut rates. Unfortunately, they don't have the data that can justify cutting rates. And need and want are two different things.
Like when I think about the risk going forward, if the economy rolls over and inflation comes in, actually, to me, that's not a bad outcome. What's more worrisome, what's more scary, and what's more difficult to actually construct a portfolio for is what if inflation continues to surprise to the upside? What if the stock or the economy keeps being stronger than everyone expects? And then that ends up being a much more difficult situation.
Your question hits the nail on the head because bond yields are the epicenter for the markets. And that's something that, started to happen in 2022, of course, when we had the big rate reset, when the Fed, went off to zero bound, inflation was a clear and present danger. And the Fed raised, 525 basis points, bond yields rose, dramatically. And so to me, rising yields are the thing that are most likely to give the stock market a wobble here.
Well, Jim, you just heard it. Some of the points we were just making right here. What are your thoughts?
Markets are really starting to come around to this idea that the economy is stronger. There's going to be no rate hike. But I would caution that in the bond market, we're probably in the seventh or eighth inning of this move higher in yields. It started way back at 3.8% in late December. And now we're at 4.7%, or roughly at 4.7%. If the Fed's not going to hike rates, and that's really not on the table, there's a limit to how high rates can go. And that's why I've longly been arguing 5 to 5.5, 4.7. I'd be kind of, in fact, I do manage an index that we have an ETF on, WTBN, and we are moving to neutral because we're getting close enough to that target. not thinking we're going to go much beyond that 5.5% range, unless, of course, the circumstances change and the door is open to rate hikes. And in an election year, there's a real high bar to get rate hikes. So I think while we could continue to see higher rates from here, there's not much more to go in the bond market. In the stock market, it's a different story. When do higher rates bother stocks? The answer seems to be April 11th when we hit 450. Stocks kind of really started to get headwind and they've fallen about 5%. And if rates start going to, 5 to 5.25, the 10-year yield, then I think, you're going to continue to see stocks struggling with a headwind as we move forward. I know today there's been no headwind, but that is going to be a big problem. So stocks might not be in the seventh inning of their correction, but bonds could very well be. So yes, higher for longer. Yes, more inflation. Yes, no rate cuts. But bond market's been stiffing this out for a while, and it's most of the way towards pricing it in.
As you mentioned, the 4.7%, this, of course, is on the 10-year yield. Talk a little bit about what's happening at the shorter end of the curve. 2s, 10s inverted right now. 2-year Treasury yield was exactly 5% earlier, now 4.998 on my screen.
Yeah, so you're really stuck at 5% with the 2-year yield for the same reason I just mentioned. If there's not going to be a rate hike, yeah, you could go above 5% on the 2-year yield. I think it hit 520 last 518 to 520 last October. So you've got some room. You could probably move a little bit higher. But if you want to talk about 5.5 or 6% on the 2-year note, I'd open the door for rate hikes. So there's very limited move there. But that can mean that the 10-year yield can still go to 5.5, which is a fancy way for me to say that the yield curve could go to zero. And so we could pretty much uninvert the curve or almost uninvert the curve in the next couple of weeks. So this 2-year long period of the yield curve being inverted could be coming to an end, but it will be coming to an end in a way that no one really expected, because normally the yield curve will end its inversion, which is in bond market parlance, a bull steepener. That is falling interest rates with short-term interest rates falling faster, falling below long rates to steepen the curve. This one will be a bear steepener where rates are rising, but long-term interest rates are rising faster to basically uninvert the curve. That's a rare instance when you see that. And that is worrisome, because the only other times in history that you've seen any kind of a bear steepener, that S word, that stagflation word, was associated with it. Remember, we're only talking about it going to zero here. We're not talking about it massively steepening. Maybe that comes later in 24 and 25 if we start talking about hikes. Again, I keep bringing that hike word up, but I want to emphasize there is no hike priced in, but we are starting to think that way, and that is a little bit of a shift.
Yeah, it's a big shift from where we were earlier in the year and later last year when we saw this bake-in of what was it, 325 basis point hikes?
Yeah, in fact, at its most in early January, we were at almost 7 hikes, or 7 cuts, excuse me. So the market was, like they said, the market was way over its skis in January, and now the market is at less than 1. So we'll have to see when the Fed meets in June, or maybe even next week. Next week is a monster week for the bond market, because we start the week with the quarterly refunding announcement. Everybody remembers in November when Janet Yellen changed the mix and said, I'll issue more bills and I'll issue less notes. It sparked a gigantic rally. I think she played that card already. Everybody knows that. They're looking for it. So it's going to be hard to play that card a second time on Monday. Wednesday is the Fed meeting. Now, we don't expect anything out of the Fed meeting, but then 30 minutes later is the press conference, and maybe Powell drops some hints at the press conference. And Friday's the payroll report. 250,000 is expected. It's 303,000 the month before. So the payrolls are expected to come down from the previous month. The last couple of months, payroll report's been beating again. It's been higher than expected. And that's why we've got, no rate cuts talking about in this market, because the economy's been so strong. So Monday, Wednesday, Friday are going to be big data points for the bond market next week.
Jim, let's zoom the camera out a little bit. For folks who don't spend a lot of time focusing on the bond market, it may be easy to lose sight of just how big a swing this is. You mentioned, I guess, 7 rate cuts being baked in, 175 basis points. Now we're talking about hikes. These are huge, huge swings in what was happening in the Fed funds future markets in a relatively short period of time. Talk a little bit about what caused that unprecedented move.
Yeah, I think what caused the unprecedented move is very simple. Everybody got their forecast wrong. They started the beginning of the year until late last year with this idea that the economy was going to slow into a soft landing, and it was going to slow maybe into a recession. There was some recession talk, and then as January, February, March came, we started to realize how offsides that forecast was. There was no soft landing. There was no recession. There was strong growth. That's good, right? But with that strong growth came stickier inflation. We started the year talking about this concept of a last mile. That
Yes.
last mile was going to be inflation going from 3% to 2%. It went from 9 to 3, and then the last mile was going to be inflation going from 3 to 2. Well, looks like what we've done this year is we've taken inflation from 3 at the beginning of the year to 3.5, and it might actually go over 4 before the end of the year. So that last mile is now looking like a half marathon. And this is why we've seen such a big shift in the bond market this year as rates have been moving higher and as these rate cuts have been coming out. The stock market has been a little bit slow to pick up on this. It's only been since 450 about a couple of weeks ago on the 10-year note. Why? Because in the stock land, the last time I was on with Maggie, I made fun of it, right? The stock guys would say, but Jay said he's going to cut rates. So you can save a lot of money by canceling your Bloomberg. You don't need to look at anything else. Jay said he's going to cut rates. So therefore there will be rate cuts. And only in the last couple of weeks have they started to realize, well, he may have said it, but it all of a sudden doesn't look like he's actually going to do it. And that's why, like I said, maybe the bond market's further on in this adjustment process with the stronger data in the 7th inning or something like that. But the stock market only started about 3 weeks ago, so it might only be in the 3rd or 4th inning of this adjustment.
You can't cancel your Bloomberg, man. Mayor Mike locks you in for 24 months. That's why he's the richest man in New York City.
Yeah. Oh, really? I could get 24 months. I think I'm on a lifetime deal. Then my estate's going to be paying for this thing after I'm long and gone.
By the way, Jim, I should say, I should take a victory lap on this because you were early to this call. I believe you were the first person I heard the phrase "no landing" from.
Yeah, no landing. Remember, that's just stick with the airplane metaphor of hard landing and soft landing. And no landing just means that if the economy's potential, and potential is what economists think the economy will do if it's not being stimulated or restrained, and most of them think it's about 2.5%. I've argued, no landing is it just keeps going at least 2.5%. And largely for the last 7 quarters, that's what it did. Now it dipped down a little bit below that in the first quarter, but we'll have to see because like I said earlier, that was a lot of inventory and exports, and that stuff can swing big in the next quarter and, just push it right back up. And prior to that, we had 6 quarters in a row of at least 2.5%. So that's what the no landing is. And that's what I always thought. I just thought that the economy was not showing any signs of slowing. And now that is largely a consensus view.
Hey, let's talk a little bit about inflation. I was talking about this with Tom Thornton yesterday. While we were talking, I jumped on the Fed database and baselined inflation from April of 2020 to the last month, which is March of 2024. 121% is where it came back, meaning 21% or 21.9. So 22% increase in prices. This idea that we've come down from 9% to 3%, this last mile idea. Let's talk about how pernicious this is. I had an uncle who used to like to jump out of airplanes. He was really into skydiving. And the joke in the skydiving community is it's not the first 10,000 foot free fall. It's the last 6 inches that kill you. Are we in that sort of period there where this sustained inflation just sticks around and just devastates? It's just so pernicious.
We already might be there because you're right that the inflation rate since 2020, since the recovery began, is up something along the lines of about 21%. But wages are up around, depending on how you measure it, 16 to 18%. So wages have not kept pace with inflation. So, what you can buy, you're losing ground on. Now, let me throw out one other statistic at you. The BLS does do an inflation report based on income levels. And if you're in the lower income levels, meaning that something like 75% of your paycheck goes to housing, transportation, and food, and in that case, food is grocery store, your inflation rates may be 1% higher than in the upper income levels, where less than 50% of your paycheck goes to housing, transportation, food. And in that case, food's largely restaurants. So those people have been really falling behind. Now, in the last few months, they've been maybe getting some relief that wages have been growing a little bit faster than inflation, but that is not offsetting the first 3.5 years, which is why there's a lot of anger in the polling data and everything else. When you ask people, what is the most important issue? What are the two most important issues in the economy? Other than you will get some people talking about immigration, which you could argue is somewhat economic, it's inflation in the economy. And it's largely meaning about inflation and about the growth of their paycheck. So yeah, it's a real problem. And that's why I think the Fed was correct in 22 and 23 to say, look, we got to get this inflation rate down. And me, Jay Powell, has to raise rates 75 basis points every meeting, and I have to crush the stock market, you as an owner of stocks or assets, just do your patriotic duty and lose money with dignity, because then you'll stop spending and then we'll bring down inflation. Well, that was 22, 23, but late 23 and into 24, it's almost like Jay said, okay, enough of that. We need to, give some relief to the upper half. We need to kind of, get a 28% 6-month rally going in the stock market, which we did from October through March. And the problem is that might be reigniting some more inflation fears. So yeah, the inflation problem is still with us, and it is going in the wrong direction. As I said, it started at 3, the year-over-year CPI. It's probably at 3.5 now, and credibly can make the case we're going to see a 4 handle before the end of the year.
Yeah, losing money with dignity is one of the toughest things to do.
Right.
By the way, I mean, just to point out the obvious here, when you talk about how wage growth has not kept pace with inflation, those wage numbers that you state, they're not evenly distributed, right? So if you're in a job, you're not moving positions, very rare to have your employer come to you, tap you on the shoulder, and say, "Hey, listen, I've been looking at CPI. You're not really doing great here. I want to hike you like 20% on your pay."
No, you won't get any of that at all. You're right that, in fact, in the Atlanta Fed wage numbers, they do break it down between what they call job switchers and job stayers.
Right.
And if you want to get a raise, you gotta get into a different job. Job switchers also includes promotions. So you've either got to get a promotion or you got to go to another company if you want to get a real wage hike. You don't get it just by sitting still and hoping that, you're going to get some kind of cost of living adjustment. And again, too, the Atlanta Fed breaks this data down by income levels too. And there's a wide disparity among income levels too, depending on how much money you make, whether or not you're going to get a wage. It's not uniform across the board.
Right. And of course, people at the lower end of that distribution have a much higher marginal propensity to consume versus save, which means they're paying an even greater percentage of their income on things like consumer staples. And it just on and on for the pain that this has been causing. Jim, we got some great questions coming in. First one from Justin Smart, maybe a more poignant question. Does the Fed have any good options left?
Well, I guess the answer is, what do you mean by good options? The Fed can hold. The Fed can raise rates if they think that the data is coming in strong. If they, the reason I say that is if they do the right thing to bring down inflation, but it brings down the stock market, is that a good outcome? If they do the wrong thing on inflation, which I think they've been doing for the last 4 or 5 months, but the stock market's up 28%, was that a good outcome? So it's a difficult question to answer without answering what is it you're defining as a good or bad outcome. But now that I've said all that about the semantics of the word, let me throw out that there is a dynamic in this economy that we have not had to deal with in previous cycles, and that is the fiscal response. Currently, the federal deficit is 6% of GDP. What that means in English, what that means is that the government spends about $6 trillion, $6 to $6.25 trillion a year. That's about 22, 23% of GDP. That is a huge number. Usually, when you see the government spend that much, we're in recession and they're doing old-fashioned Keynesian pump priming to just throw money at everything to try and get the economy to move. Now we're in the fourth year of a recovery and they're still doing that. As a result, we've got this 6% GDP deficit. So we've got this giant deficit that's happening. When you look at a deficit of that size, as I'd like to say about the no landing scenario you were asking me about earlier, I just would say to all the soft landers and all the no landers, 6% deficit to GDP, you could cancel a soft landing with that number. You just will not get a soft landing when the government spends that kind of number. Now, what you will get is positive GDP, maybe at trend or potential or higher, but you could also very well get inflation too. So the Fed is, if you want to ask the question, do they have no good options? Yeah, if the federal government is going to act like we're in the 8th month of a recession and they're in full panic, throwing money at everybody to end it, that's the level of spending that we have right now. But we're not in the 8th month of a recession trying to get everybody employed. We're in the 4th year of an expansion and we've had unemployment under 4% for 2 years. So if they keep spending at that level, we are going to continue to have an inflation problem. And we will also have positive GDP.
Yeah, that's no longer Keynesian pump priming, right? I mean, that's not the thesis behind it, which is you spend, you put your foot on the gas pedal when you need to accelerate, when you need to run loose. That's not the case here.
No, this is put your foot, put the pedal to the floor and just put a brick on it and just leave it there forever. That seems to be the point that we're doing now. And if you want to extend that metaphor out, if you put a brick on the accelerator and leave it there forever, eventually you're going to crash. And that's the risk that we face with this level of spending. And the unfortunate thing about it is, what stops it? I don't think we're going to stop it at the ballot box. I don't look around and see a Alexander Hamilton or a Thomas Jefferson that's going to rein in the spending that we have. I don't care who we vote for. If we vote for the Republican, the Democrat, or any of the independent candidates, or whatever party comes in, they're all going to spend. The only thing that's going to stop this is going to be a financial crisis. It's going to be high, suffocatingly high interest rates that just forces the government to stop spending. Now that I've said that, I know how it's going to end. At least I think that's how it's going to end. I just don't know when. That doesn't mean that I said the only thing that's going to end all this spending is going to be a financial crisis. That could be in 15 years. That could be later this year. But I just don't think that we're ever going to, elect people that are going to say, let's turn the temperature down slowly. Let's rein in the spending. Let's get everything under control. We're not going to do that. Other people say, well, they could just create inflation and they can inflate their way out of the debt. Well, yeah, that'll also produce, suffocatingly high interest rates as well. And that kind of gets to that financial crisis argument that I've made.
Hey, Jim, let me switch gears here just a little bit. We've been talking about this broader macro context. What does it presuppose? What does it imply? And what's your view about what it says about asset allocation in this environment?
Asset allocation has changed. The 60-40 portfolio was predicated, or the risk parity trade, or the concepts of risk on and risk off. They were all predicated on this idea that stock and bond prices were inversely correlated. One would go up, the other would go down. Stocks would go up, bonds would go down, and price up in yield. Then when stocks sold off, you'd have a risk-off trade and bonds would rally, and so they would cushion you on the downtrend. The entire wealth management community was built on this. Risk parity was built on this. The terms risk on and risk off came on this. That, I would argue, ended a couple of years ago. Now stock and bond prices move up and down together. They did that from the 60s to the 90s. They're doing it again. Why did it switch? Because of inflation. When you have inflation, they move up and down together. When you don't have inflation, like we had from 2000 to 2020, they move inversely. Does that mean that bonds have no place? No, they do have a place. They're just a different type of asset, a different, they're a low beta version of the stock market. They move with it. but in a low beta, high yielding kind of way. That is a different type of management for the bond market, is what that winds up being. It's no longer the 60-40 type of argument. People then ask, well, where's the uncorrelated asset that I could buy so that when things go down, it goes up? It ain't crypto. It ain't gold. It ain't bonds. It ain't commodities. There isn't one. When you get into a fear of inflation, like we are now, everything's correlated. It's just, what is the beta? The highest beta would probably be like, NASDAQ stocks or crypto. They go up the most, but then they go down the most. And then like the lowest beta would probably be short-term bonds. They go up a little bit and they go down a little bit with a yield. And so you need to start to understand that you have more risk, that when the market goes down, everything's going to go down. It's just that, if you're in the safer assets, you will go down a little bit less. If you're in the riskier assets, you will go down a lot more. Now, that isn't every day, because, some people could say, but the stock market's up a lot and the bond market isn't. Yeah, but for the last couple of years, that's the way it's worked. And for the next several years, I think that's the way it's going to continue to work.
You mentioned just a couple of points there. You mentioned gold, you mentioned commodities. Talk a little bit about whether or not that can provide some sort of offset. I know you say that everything is correlated, but are there any places to hide? Gold is one, for example.
Well, I guess the answer to the question, is there anywhere to hide, is there any uncorrelated asset? And that is that it has a correlation of 0. Probably the closest thing we have right now is gold and in the commodities, more so than crypto. Bitcoin is still very correlated to the stock market. It's just a higher beta version of it. And one of the things that seems to be driving gold right now, which is why it's been such a surprising move, is we're all Americans listening to this, or most of us are, and we all think that we matter the most in the gold market, and we don't. So we look at the ETF flows, and we look at what's going on with the commitment of traders in the COMEX market, and we don't see a whole lot of action going on there. So we conclude, well, gold's not going to do anything, but it's going straight up, because most of that buying is coming out of the Middle East and Asia. It is absolutely blowing the roof off, the amount of buying that is coming out of China right now. Why? The Chinese economy is in trouble. There's political instability in China. And I think a lot of people in China, a lot of wealthy people in China, are hiding in gold. And that's why you're seeing the amount of gold purchases coming out of China is just through the roof right now. And that's why, as Americans, and we're looking at ETF flows and commitment of traders, we completely missed it. And so maybe because of that, you're starting to see that as probably being the most uncorrelated asset. But really what you're playing for there is a continuation of political instability, either out of China or the Middle East, which is where most of the buying has been coming from. But if the answer is there a asset like bonds were from 2020 to 2020, that it was just uncorrelated, negatively correlated with stocks? No, that era is over. And that, finding a giant asset class, like, well, bonds are the biggest asset class. They're actually bigger than stocks, that just move negatively. That just, I don't think exists anymore. I think that ended a couple of years ago.
Jim, since you mentioned it, what are your thoughts on what's happening right now in crypto?
I'm going to get myself in trouble with my Maxi friends again, because I'm going to say some not nice things. Two things. I think that people have way overstated the halving. The halving is basically taking the inflation rate on Bitcoin from about 1.7% to 85 basis points. 90 basis point change in the inflation rate, the amount of crypto that is added to the existing list every year, is now a little less than 1% from a little bit less than 2%, isn't going to move the needle. Three epochs ago, 4 epochs ago, when the halving went from 20% to 10%, and there was a lot less Bitcoin that had been mined, that was a big deal. When it went from 10% to 5%, and there was a lot less mined, that was a big deal. But now the halvings, I don't think, matter as much. And I think the next one and the next one don't. Now, I know the way that the crypto crowd says it. There's this halving. Somewhere in the next 4 years, there will be a rise. That's because of the halving. And in about 2 years, the rise will be because there will be another halving. and all the declines will be forgotten, but then we'll just remember the halving when it goes up. I think that's a non-issue. I know that's a heretical thought for me to say, but I don't think it's a non-issue. On this spot
Jim,
Bitcoin ETF,
I'll take devil's advocate here and say
okay.
I think what the Bitcoiners would say is that what halvening represents is a decline in the rate of expansion. So that eventually goes to zero, and the hard cap, 21 million Bitcoin, remains the hard cap of 21 million Bitcoin. And what gives them the sense of stability and security, in their view, is the fact that the monetary policy is defined, which is more than what we can say for global central banks. That's the case.
Sure. And you're absolutely right. And that has been known since 2009. And it has been completely in the price since 2009. And if you're talking about monetary policy of a crypto that is a low inflation rate, then after EIP 1559, you should be buying ETH because it's had, and especially after the merge, it has had a negative inflation rate for almost 2 years now. And so it has got a much lower inflation rate. Now, theoretically, there's an unlimited number of ETH that you could create, so it doesn't have a cap at the top, but it has a negative inflation rate between EIP 1559 and the merge. The point is, all this stuff is known. This is not something new. Markets move on news that was not expected. Expected news is usually in the price. And when you get to these small changes in the inflation rate, they just don't matter as much as the earlier versions used to matter. The other thing I want to, yep.
I'm just so chuffed to hear you say EIP 1559.
Why is that?
It's
The
fun.
Ethereum improvement proposal, number 1559. Yes.
It's fun to hear you talk about Ethereum.
Yeah, I know, because now the maxis have all of their conspiracy theories that I'm actually an ETH maxi trying to crap on Bitcoin or something like that. Actually, I own Bitcoin, I own ETH, I am a crypto enthusiast, and have been a crypto owner now for about 7 years. Let me bring up another issue. The spot Bitcoin ETFs. When you get crypto people talking about ETFs, it's almost axiomatic they get the story wrong. They got the story wrong about that Tim Buckley was being fired from Vanguard because he didn't have a Bitcoin ETF. They're getting the story wrong about the buying of the Bitcoin ETFs. Who's buying it? Oh, the boomers are buying it through the wealth managers. Well, the wealth managers have to file 13Fs. Now they've been filing them, and they have till May 15th to continue to file them. So they're not all in. But what we're seeing is virtually none of the Bitcoin ETFs have been bought by wealth managers, maybe 0.5%. Put that in perspective. The GLD, which is $50 billion, and the 10 spot Bitcoin ETFs are around $50 billion. 25-30% of GLD is being bought by wealth managers. HYG, which is the high yield ETF, I'm picking these because these are not stock ETFs, about 70% of that is being bought by wealth managers. LQD, which is the investment grade bond ETF, something around 40 to 50% is being bought by wealth managers. So 70 in high yield, 50% in investment grade, 30% in gold, 0.5% in crypto. The other 99.5% is being bought by individual investors. And what my fear has been, and what I've been trying to articulate about this, that has got to the chagrin of the crypto community, is you've got a bunch of paper-handed small retail investors that are here for number go up. And when number doesn't go up, they start getting very nervous. And what we've seen for the last 7 weeks is the flows have stopped. And this week, we finally started to see the end of the streak of inflows into the Bitcoin ETFs. The IBIT, the BlackRock ETF, has had zero inflows for the last 2 days. Fidelity, the second biggest one, had an outflow yesterday. The first one yet. I think Galaxy and Bitwise also had outflows. I know 2 others did. I might have those names wrong, but the rest of them had no inflows, essentially. So if the price, and I've been calculating this statistic, and I've put it on Twitter a couple of times, that I calculate like the average price that it's been bought every day. The average purchase price of all these Bitcoin ETFs since January 11th, when it started trading, it's around $59,000. We're at around $63,000. So the average spot ETF has about a $4,000 profit. Now we go under 60 grand, going 59, 58,000, something like that. Then all of a sudden, that $50 billion that is sitting in those ETFs becomes overhead supply. And it just that becomes the firepower to sell and sell and sell, because it's not long viewed wealth managers on the behalf of boomers that are taking a multi-year view. It's paper handed degens that want to buy a Lambo next month. And when they start seeing the price go down and they start seeing their dreams of Lambos going away, they're going to sell. And when they get below their cost, that's the way that a lot of these ETFs trade. Everybody loves them until you get to their cost level, and then they get really antsy and start selling. You could wind up having all of this Bitcoin ETF inflows being the biggest single problem. Now that I've said that, let me repeat. 59,000 is roughly, I'll put these charts out over the weekend on my Twitter feed. 59,000 is roughly the break even for where everybody's bought. We're at 63 right now. So you've got a $4,000 cushion, about 8 or 10%. If that disappears, then we've got a real problem on our hands. The mistake everybody made is it is wealthy boomers on the golf course at the Greenwich Country Club calling their wealth manager saying, put 5% of my net worth in Bitcoin. And what we're finding is maybe 20 or 30 of them did that out of about 300 million people. And it is really not that is really not what's been happening.
Paper-handed degens will get the comments going. Jim, I love talking about macro with you. I love talking about stocks and bonds. I love talking about crypto. By the way, I should say you've joined us before on Real Vision Pro Crypto. Yesterday, we launched Real Vision Crypto. This is something right now that we've just launched to talk about digital assets and to provide an on-ramp to people who maybe have not been paying as close attention to the space as we know you have, Jim. And you can go and take a look. Looks like they're about to change the URL on me. I think it's realvision.com/RVC. That's realvision.com/RVC. I think we're doing a limited time special offer on price there if you want to check that out. Jim, every time we do these, I enjoy it. It's been great for me, especially. I feel like I got a lot smarter just getting this big picture 50,000 foot overview recap on what you think is happening in macro right now. We've covered a tremendous amount of ground on this conversation. Final thoughts, key takeaways that you'd like to leave our listeners and our viewers with.
The economy is doing better than expected, and that comes with a cost of more inflation. The bond market sniffed that out, and that's why you've seen nearly 100 basis point rise since December in rates. That rate rise is almost over. The stock market's still got a little bit more to go, and I don't think rates are going to go much beyond 5 to 5.5. We're 470 now. We were at 380 4 months ago, so that gives you an idea of how far we've come. But that is going to continue to be a big issue, those higher rates from here. And while hikes are not on the table, if the data gets stronger and the H word, the hike word, does really start to become kind of a mainstream idea, Fed might hike again, that is a game changer. Now, we're not there now, and that's going to take a lot more stronger data than we've had. But just the fact that it's even being discussed, as you mentioned, 90 days ago, we were talking about whether there was going to be 6 rate cuts. Now we're talking about 0 rate cuts and maybe that H word, So we've come a long way, and we could see which way we go from here.
Jim, I hope no matter what happens, you'll come back to join us and to explain it for us. You're one of our favorite guests here on Real Vision. Always enjoy these conversations with you, man.
Thank you, and have a good weekend, everybody.
Thanks so much for watching. Thanks for listening to Real Vision Daily Briefing. We'll be back next week. Enjoy the weekend. Have a good one, everybody.